Welcome, class. Today we're going to really dig into one of the most fundamental principles in all of accounting, the measurement principle. Now, I know it might sound a little abstract, but I want you to get this from the get-go. Without this one single rule, the entire, complex, global economy that we all operate in, well, it just wouldn't be possible. It's the very bedrock we build everything on. Financial statements, company valuations, you name it. So, let's get started. All right, let's start with a foundational challenge that every single one of you is going to face. It doesn't matter if you're an analyst, a manager, or an entrepreneur. It is the classic problem of trying to compare apples and oranges. Except in the business world, we're not talking about fruit. We're talking about comparing things like heavy machinery, real estate, software code, and brand reputation.
So I want you to picture two companies. Company A is a logistics business, and it owns a fleet of 10 delivery trucks. These are tangible assets, right? You can see them, you can touch them. Now, Company B is a tech startup. Its main asset is a single, but incredibly valuable software patent. That's an intangible asset. So here's the question. How do we, as financial analysts, objectively compare these two companies? How in the world can we put a physical truck and a legal document on the same scale to figure out which company is actually worth more? I mean, on the surface, it really does seem impossible.
And let me be perfectly clear here. This is not just some theoretical puzzle for a textbook. Without a common shared standard of measurement, our financial systems would just grind to a halt. I mean, think about it. Imagine you're trying to get a loan from a bank. How could the bank possibly assess your company's collateral if they can't put a value on your assets? Or how could an investor decide whether to put money into, say, Ford versus Google if they can't compare their financial health? Forget investors. Management wouldn't even be able to track their own performance from one year to the next. The result? It would be a total breakdown of trust and the flow of capital. It would be, for lack of a better word, chaos.
So how did the business world solve this massive problem? Well, it was through a brilliant and actually deceptively simple invention, a universal language. I want you to think of it like a financial Rosetta Stone. This language is what allows us to translate the value of literally every asset you can think of, from a whole fleet of trucks to a single software patent, into one single, universally understood format.
And this solution, formally, is what we call the measurement principle. Now, it's held up by something we call the monetary unit assumption. That's just a fancy way of saying we all agree that economic activity can and must be recorded in a common currency. For companies in the US, that's the dollar. This principle, which is enforced by rulemaking bodies like the FASB here in the States and the IASB internationally, is what brings order to all that potential chaos. It's what makes it possible for us to look at a financial statement from Tokyo or Toronto and know that we're all fundamentally speaking the same economic language. It's what allows for real, meaningful comparison.
Okay, so, like any language, this financial language has its own grammar, its own set of rules that dictate how we express value. And to really become fluent, to be able to accurately read a company's financial story, you have to master this grammar first. So let's break down these rules of measurement.
So the grammar of this whole principle really rests on a few core components. First, you've got the monetary unit itself, the currency. We have to assume that the currency, like the US dollar, is stable, free from major inflation. And that's an assumption we can definitely challenge in certain economies, but that's a topic for another day. Second, once we've agreed on the currency, we have to decide how to state the value. And this brings us to the two main dialects of accounting valuation, historical cost and fair value. Historical cost is exactly what it sounds like. It's what the company paid for an asset originally. Fair value, on the other hand, is what that asset is worth on the market today. And this ongoing debate, this strategic choice between these two methods, is honestly one of the most important and dynamic areas in all of financial accounting.
And this really brings us to the heart of the matter, the great debate in measurement. We have these two competing philosophies. Should a company's financial statements reflect the objective, verifiable fact of what they paid for something in the past, or should they reflect the current, and you could argue more relevant, economic reality of what that asset is worth right now? I promise you, this isn't just some academic question. The answer has huge implications for investor decisions, for loan agreements, and for how a company is valued in the market.
All right, let's really dissect these 2 points of view. So on one side, you've got historical cost. This is all about reliability. It's about being verifiable. Its greatest strength is its objectivity. There's an invoice, a contract, a receipt. It's a hard number, and it isn't subject to someone's opinion or the whims of the market. This is exactly why Generally Accepted Accounting Principles, or GAAP, requires its use for most long-term assets like property, plant, and equipment. But then, on the other side, you have fair value.
Its main advantage is relevance. It answers the question, what is this asset worth to my business right now? But, and this is a big but, that relevance comes at the cost of objectivity. Figuring out fair value might require subjective appraisals or complex models. It's just inherently more volatile. GAAP usually requires fair value for things like stocks and bonds, financial instruments where there's a ready market price that's highly relevant.
Let's make this really concrete. Let's run a quick scenario. A company buys a small office building for $500,000 back in 2010. Now, more than a decade later, the neighborhood has exploded and that same building is appraised at $1.2 million. So the question is, which number should show up on the company's balance sheet?
You can just imagine the conversation happening in the boardroom. The chief financial officer, the CFO, probably leaning on the principle of conservatism, would argue for historical cost. They might say, look, our books have to be based on objective facts. We have a deed for $500,000, that is the verifiable number. If we record $1.2 million, we're booking a gain we haven't even realized yet, and that appraisal is just an opinion. It could change if the market turns. But then, the chief strategy officer might push back and say, that is completely misleading. We are showing a picture of our company to investors that understates our assets by over $500,000. Anyone analyzing our return on assets is going to get a totally skewed picture. The $1.2 million reflects the true economic reality and the value we've built. And you know what? They both have a valid point. It all comes down to that tension between reliability and relevance. Now, as future analysts and managers, understanding this tension is what will help you avoid some really critical mistakes. The number one error students make is assuming a company's book value is the same as its market value. It's not. Because we use historical cost so much, a company's balance sheet can be hiding massive amounts of value. Think about a company like Disney. The land for Disney World in Florida, they bought that back in the 1960s. On their balance sheet today, that land is carried at a tiny, tiny fraction of what it's actually worth, billions of dollars. So if you were to calculate their asset value just based on their balance sheet, you would be grossly underestimating the true worth of that company. You have to learn to look past the book value and ask the real question. What is the underlying economic value of these assets? And this brings us to our final, and honestly most important point. Why have we spent this much time on a single principle? Why is mastering this concept totally non-negotiable for all of you as future business leaders? The reason this matters so much is that the measurement principle provides the foundation for a financial system that's built on three pillars: consistency, comparability, and trust. Because all public companies have to follow the same set of rules, we get consistency in financial reporting. That consistency is what allows for comparability. It means we can put the financial statements of Ford and Toyota side by side and do a meaningful apples-to-apples analysis. And that comparability is what lets investors efficiently put their money into the most promising, best-managed companies. And ultimately, this whole system creates trust. Investors, banks, regulators, they trust that the numbers represent a consistent application of established rules. And without that trust, our capital markets just couldn't function. It's that simple.
So, I want to leave you with one final thought to carry with you. The next time you're looking at a balance sheet, don't just accept the numbers as the absolute truth. I want you to look at that line for property, plant, and equipment, and I want you to ask this critical question. Given that these assets are probably recorded at historical cost, what is the story these numbers are not telling me? What hidden value, or maybe even a hidden liability, might be sitting there just waiting to be unlocked? The ability to answer that question, well, that's the difference between being a bookkeeper and being a true financial strategist.